Imagine if money was less about math and more about psychology. How different would our lives be? That's where this journey begins, because money is not just about numbers on a bank statement or stacks of bills in a vault. Money is about human behavior, about how we think, feel, hope, and fear. Many people assume that building wealth is a purely logical game, but the truth is far messier. Money is a story of our emotions, our habits, and the lens through which we see the world. You could have two people with the exact same amount of money. One is miserable and restless, while the other is content and free. The difference isn't the math, it's the psychology. Morgan Housel's The Psychology of Money is not a traditional finance book filled with tips and stock market tricks. Instead, it is a deeply human exploration of how we think about money. It reminds us that being wealthy isn't just about earning more. It's about how you save, spend, invest, and most importantly, how you manage your expectations. Take this simple story. Imagine two men, John and David. Both have a net worth of $1 million. John constantly worries that it's not enough, that someone else always has more, that he might lose what he has. David, on the other hand, feels secure. He knows his money will provide for him and he doesn't obsess about what others have. Both are technically millionaires, but only one of them is truly rich. That's the power of perspective. All of us carry unique money stories shaped by where we grew up, what we saw, and what we experienced. A person who grew up poor might treat money as a precious resource to guard and protect, while someone who grew up wealthy might see it as just another tool. Neither is right or wrong. It simply shows that money is always personal. Our experiences build our financial worldview, and no two are ever the same. That's why some people take huge investment risks with confidence, while others hesitate even when opportunities are safe. Consider the 2008 financial crisis. Some people lost everything, while others not only survived but came out stronger. The difference wasn't about IQ or insider knowledge. It was about perspective, patience, and emotional control. Money is not just numbers on a screen. It's also how we react when fear and greed collide. One of the most fascinating examples is the story of Ronald Reed. He worked as a janitor and gas station attendant his entire life. To everyone who knew him, he looked like a man of modest means. But when he passed away, the world was shocked. He left behind an $8 million fortune. How? He didn't invent anything, didn't start a business empire. He simply saved consistently, invested patiently, and never stopped. He mastered two things most people can't: patience and restraint. That's the essence of wealth building. Compare Ronald Reed with someone like Richard, a brilliant entrepreneur who made millions in technology. Richard was smart, daring, and admired, but he kept chasing bigger risks, higher returns, and eventually lost everything. Here we see the paradox. Intelligence and talent don't guarantee wealth. Behavior does. We often assume the formula is simple: work hard, earn more, and you'll get rich. But keeping wealth requires a very different skill set than making it. It demands discipline, humility, and the ability to manage our own impulses. That's why Housel argues that financial success is less about knowledge and more about behavior. Now let's shift to another perspective. Society loves to idolize flashy wealth, luxury cars, sprawling mansions, expensive watches. We see these symbols and think that's success. But this is often an illusion. Real wealth is not what you see. Real wealth is freedom. It's the ability to wake up and decide how you want to spend your day, who you want to spend it with, and whether you even want to work at all. That's true financial independence, and it doesn't always come with a sports car. Money's greatest power is not in what it buys, but in the options it creates. Yet, many people with enormous incomes still feel trapped because they traded their freedom for appearances. Meanwhile, others with modest earnings live rich, fulfilling lives simply because they control their own time. Greed and fear are the twin forces that often wreck our financial decisions. In investing, these emotions show up more than anywhere else. When we see others getting rich, greed whispers, "Jump in, you're missing out." And when markets fall, fear screams, "Sell everything, protect yourself." Both emotions lead to bad timing, bad decisions, and often permanent losses. The real wisdom is to master your emotions, to recognize that markets rise and fall, but if you stay calm and patient, the long game almost always rewards you. The hard part isn't knowing what to do. It's resisting the urge to do the wrong thing when emotions run high. Housel also emphasizes the role of luck. We love to believe that success is purely the product of hard work and intelligence, but reality is more complex. Timing and circumstance matter enormously. Two equally talented people can end up with completely different outcomes depending on the opportunities they stumble upon or miss entirely. Think about Bill Gates. One reason he became Bill Gates is that he happened to attend one of the only high schools in the world at the time with access to a computer. That access changed his life. Another equally talented friend of his, who didn't have the same opportunities, lived a far less extraordinary life. Skill and effort matter, but so do luck and timing. This understanding should make us humble. If we succeed, yes, we worked hard, but we also got lucky in ways we may not fully recognize. And if someone else doesn't succeed, it doesn't always mean they were lazy or careless. They may not have had the same opportunities or timing. That humility shapes how we handle wealth. Instead of constantly comparing ourselves to others, we realize that everyone's financial story is unique. The game isn't about outdoing others, it's about building a life that works for you. So here's the first big takeaway. Money is not just about what's in your bank account. It's about how you think, how you behave, and how you manage the powerful emotions that swirl around it. True wealth isn't loud. It doesn't need to be flaunted. It's quiet, often invisible, and deeply personal. This is the beginning of the journey the psychology of money takes us on, a journey that reveals why our minds matter far more than our math when it comes to wealth. And as we go deeper, we'll see how money, behavior, and human nature intertwine to shape our lives in ways we rarely stop to think about. We ended on the idea that money is not loud. It is quiet, invisible, and deeply personal. Let's build on that. When we think about money, one of the most dangerous traps we fall into is comparison. We look at the cars, the houses, the vacations, the jewelry, and we assume that people who have more of these things must be more successful, happier, or smarter. But what we forget is that wealth is what you don't see. A flashy car in the driveway is not proof of financial stability. It's proof that money was spent on that car. Real wealth is the money that hasn't been spent, the freedom it quietly buys, the opportunities it preserves for the future. And because we can't see it, we often underestimate it. Imagine someone driving a brand new sports car. You admire the car, maybe you envy the driver. But here's the truth, you're not thinking about the driver at all. You're imagining yourself behind the wheel. You're not impressed with them, you're projecting your own desire. And yet we spend so much of our lives chasing external approval, thinking other people will be impressed by our wealth. The irony is, no one is actually thinking about you, they're only thinking about themselves. Which means trying to buy respect with money is one of the most expensive and least effective strategies a human can pursue. The quiet power of wealth lies in the things you don't see, the savings account that nobody talks about, the investments that compound quietly in the background, the choices you don't make because you have the discipline to wait. This is invisible wealth, and it is far more powerful than the visible kind. Let's explore compounding, because this is one of the most extraordinary forces in the world of money. Compounding is not just about money multiplying, it's about time magnifying small decisions into massive outcomes. Albert Einstein famously called compounding the eighth wonder of the world. Why? Because compounding works in ways our brains struggle to grasp. We think linearly, but compounding is exponential, and the difference between the two is staggering. Take Warren Buffett. People know him as one of the richest men in the world, with a net worth of over $100 billion. But here's the secret most people miss. Buffett didn't make billions because he was the best investor in the world. He made billions because he was a good investor for an incredibly long time. He started investing seriously as a child and never stopped. If he had started in his 30s and retired in his 60s, like most people, he would be wealthy, but nowhere near the legendary status he has today. The magic is not his skill alone, it's his time horizon. Imagine two investors. One earns slightly higher returns but invests for 20 years. Another earns slightly lower returns but invests for 60 years. The second one almost always wins. Time is the most powerful multiplier of wealth, not just skill. This is why patience is underrated and impatience is expensive. But patience is hard. Our brains crave quick results. We are wired to seek instant gratification, to look for fast payoffs, to get restless when progress is invisible. The problem is, compounding doesn't show up in the early years. It's like watching grass grow. The real explosion happens much later, after decades of quiet, almost boring accumulation. Most people give up before the magic arrives. They pull their money, change strategies, chase faster results, and in doing so, they destroy the very thing that would have made them rich. Think of it like planting an oak tree. For years it looks unimpressive, barely a sapling. Then slowly, almost imperceptibly, it begins to rise. Decades later, it's massive, casting shade, standing firm against storms. That's compounding. And just like the oak tree, it requires you to plant the seed and wait. This lesson applies beyond money. Relationships, knowledge, reputation, all of them compound. Small acts repeated consistently over years turn into extraordinary results. But in money, because we can measure dollars, the effect becomes astonishingly clear. Here's another crucial point: the line between enough and never enough. Human desire is infinite. The moment you reach one goal, your mind immediately looks toward the next. You buy a house and soon you want a bigger one. You get a promotion and soon you want the next. The cycle never ends because comparison never ends. Someone will always have more, and if your happiness depends on outdoing others, you will never feel satisfied. There are countless examples of brilliant people who lost everything because they didn't know when to stop. Think about executives during financial bubbles. Many had millions already, more than enough to live comfortably for life. But they kept pushing, chasing just a little bit more, and when the bubble burst, they lost everything. Bernie Madoff is a tragic illustration of this. He could have retired a rich and respected man, but instead he created the largest Ponzi scheme in history, chasing endlessly for more, until it all collapsed. Knowing when you have enough is one of the most valuable financial skills. It doesn't mean you stop striving or stop growing. It means you recognize a point where the risks outweigh the rewards. Enough is not about limiting ambition. It's about protecting yourself from ruin. This ties to another truth. Avoiding financial ruin matters more than achieving maximum returns. Survival is underrated. What good is a 30% return if it disappears in the next crash because you were over-leveraged? It's far better to earn steady, reasonable returns you can stick with than to chase the highest possible gain and risk losing everything. Here, where psychology again trumps math, the rational answer is not always the right answer. The right answer is the one you can stick with over the long run. Imagine a strategy that promises slightly higher returns but keeps you up at night with anxiety, versus another that feels comfortable and keeps you invested through ups and downs. The second strategy, though mathematically less efficient, will almost certainly make you richer because you'll actually stay with it. Another idea Housel explores is tail events, the rare, unpredictable events that drive most of the outcomes in finance and in life. In investing, the majority of returns often come from a tiny number of big winners. Think about the stock market. Just a handful of companies have driven most of its long-term growth. If you missed those, you missed almost everything. The same happens in careers, in relationships, in history itself. A few rare events shape the world disproportionately. The problem is, humans are terrible at predicting tails. We look at averages and expect consistency. But real life is lumpy. It's messy. Most of the time, nothing dramatic happens, and then suddenly everything happens at once. If you're not prepared for tails, you can be wiped out. But if you respect them, if you structure your life and finances to survive surprises, you put yourself in a position to benefit from them instead of being destroyed by them. This leads us to the idea of margin of safety. Engineers build bridges to hold far more weight than they're expected to carry because surprises happen. Investors should think the same way. Save more than you think you'll need. Borrow less than you think you can handle. Take risks only with what you can afford to lose. Build slack into your life so that unexpected shocks don't ruin you. The irony is that we often see caution as weakness, but in money, caution is strength. The people who last the longest in the financial game are not those chasing the highest highs, but those avoiding the lowest lows. Wealth is built not by hitting home runs every year, but by avoiding catastrophic losses and letting compounding do its quiet work. And here's something counterintuitive. Pessimism often sounds smarter than optimism. When someone says the world is going to collapse, we listen more closely than when someone says things will be okay. Fear grabs our attention because survival is hardwired into our biology. But when it comes to money, relentless pessimism is costly. The world has a long history of progress. Crises come and go, markets fall and rise, but over time, humanity adapts and wealth grows. Optimism, grounded in reality, is the only stance that has historically paid off. The danger is mistaking short-term volatility for long-term doom. The market might crash tomorrow, but history shows it has always recovered. The long arc of progress is real, even if the path is bumpy. Successful investors are those who can hold both ideas at once, that the short term is uncertain, but the long term is hopeful. As we continue exploring, it becomes clear that the psychology of money isn't about squeezing out maximum returns or predicting the next big event. It's about survival, patience, humility, and perspective. It's about aligning your financial strategy not with the perfect spreadsheet, but with the messy, emotional, very human reality of life. And as we go deeper into this journey, the lessons will show us how these principles play out in our daily decisions, how we spend, how we save, how we dream, and how we avoid the traps that pull so many people down. We left off with the idea that money is less about perfect spreadsheets and more about survival, patience, humility, and perspective. Let's keep building. Think about how often people try to predict the future of markets, economies, or even entire civilizations. Experts on TV confidently declare what the stock market will do next month, which company will double, which country will collapse. But the truth is, no one knows. The future is inherently unpredictable. Yet, human beings crave certainty, so we believe predictions even when deep down we know they are guesses. This illusion of certainty makes us vulnerable. The smarter approach is not to try and predict every twist and turn, but to prepare for a range of possible outcomes. Imagine you're sailing across the ocean. You can't control the wind, the storms, or the currents, but you can control your boat, its strength, its sails, its supplies. In money, preparation beats prediction. You don't need to know exactly what will happen. You need to know you'll be okay regardless of what happens. This is why saving money is so powerful. Savings are not just about building wealth, they are about giving yourself flexibility. Having extra cash is not a sign of laziness or inefficiency, it's a sign of resilience. When life throws a curveball, savings buy you time. They give you options. They prevent you from being forced into decisions you don't want to make. In fact, savings are the gap between you and chaos. There's a story of a man named Greg who worked in a stable job for years. He was careful with his money, lived below his means, and built a healthy savings account. When his company suddenly went bankrupt, many of his colleagues panicked, forced to take whatever jobs they could find to pay the bills. But Greg, he had a cushion. He took his time, found a role he truly wanted, and actually ended up happier. His savings bought him freedom, not just financial freedom, but freedom of choice. That is the hidden power of money. But freedom is not the same as extravagance. Many people believe freedom comes from earning more, but in reality it comes from needing less. If your lifestyle constantly expands with your income, you trap yourself in a cycle where more is never enough. The higher your expenses, the less flexibility you have. Every raise, every promotion, every windfall disappears into a bigger mortgage, fancier cars, or luxury habits. Suddenly, instead of owning your wealth owns you. This is why frugality, though often misunderstood, is a form of power. It's not about deprivation or self-denial. It's about controlling your needs so you can control your life. Someone who earns $50,000 a year but spends $30,000 may have more freedom than someone earning $500,000 but spending $490,000. The second person looks rich, but they are actually fragile. The first person looks modest, but they are resilient. True wealth is not the number on your paycheck. It's the gap between what you earn and what you spend. And here, where human psychology makes things tricky. As social creatures, we are wired to compare ourselves. We don't measure success in absolute terms. We measure it relative to others. If your neighbor gets a new car, you feel a pull to upgrade. If your friend vacations in Italy, suddenly your weekend trip feels small. This endless comparison is the thief of joy and the enemy of financial stability. Because when you play that game, there is no finish line. No matter how much you have, someone will always have more. And as long as you chase them, peace will remain out of reach. So how do we escape the comparison trap? By redefining what money means to us. Instead of seeing it as a scoreboard, we see it as a tool. A tool for security, for freedom, for peace of mind. A tool that buys us the ability to live life on our own terms, not to impress people who probably aren't paying as much attention as we think. Now let's talk about risk, because money is never separated from risk. Every decision we make carries uncertainty. Investing in stocks, starting a business, even keeping money in cash, all of them have risks. The trick is not to avoid risk, but to understand it, respect it, and manage it. The danger comes when we underestimate risks, especially because the world changes faster than our memories adjust. People who lived through the Great Depression in the 1930s were scarred by it. They saved obsessively, avoided debt, and feared markets for the rest of their lives. Someone born in the booming 1950s, on the other hand, might see markets as always rising, always safe. Both are responding rationally to their experiences, but their experiences are incomplete. The past they lived through is only one slice of reality. This is why risk feels so personal. What looks reckless to one person might look perfectly safe to another, simply because their memories are different. Understanding that others see risk differently helps us become less judgmental. It also reminds us to stay humble. We don't know everything. We can't. We only know what we've lived. And risk doesn't just shape our fears, it shapes our opportunities. For example, think of someone who invests in the stock market during a downturn. To many, it feels terrifying. To them, it's a chance. The same event, two different reactions, leading to two very different outcomes. Which means the key is not to find a universal definition of risk, but to define what risk means for you. This connects with another lesson: room for error. If you invest or live in a way that assumes everything will go right, you're setting yourself up for disaster, because sooner or later something will go wrong. And when it does, without room for error, the damage is permanent. The world rewards people who can stay in the game the longest, and staying in the game requires being conservative enough to survive the bad times. A good analogy is driving a car. The speed limit might be 65, but if you drive exactly 65 inches away from the cliff's edge, one mistake and you're gone. The safe driver leaves space. In money, leaving space means not borrowing too much, not betting everything on one outcome, not assuming the future will look exactly like the past. It means protecting yourself from the unknown. Now let's reflect on optimism versus pessimism again. We touched on it earlier, but it deserves more. The reason pessimism feels so compelling is because progress happens slowly while setbacks happen suddenly. It takes years to build a skyscraper, seconds to destroy it. It takes decades for markets to grow, days for them to crash. That's why bad news is always louder. It shocks us. But if you zoom out, the long arc of history shows steady, undeniable progress. Humanity adapts, rebuilds, reinvents. Optimism is not blind faith. It is rational recognition of what history shows us, that despite setbacks, the trajectory bends upward. And yet, optimism must be balanced with realism. Blind optimism leads to recklessness. Blind pessimism leads to paralysis. The healthiest mindset is what Housel calls sensible optimism, believing that the future will be better while preparing for bumps along the way. Think of it like hiking a mountain. You know the trail leads upward, but you also know there will be rocks, rain, and exhaustion along the way. If you prepare for those challenges, you keep moving forward. If you pretend they don't exist, you get blindsided. And if you focus only on them, you never start the climb. All of this brings us back to the central theme. Money is not about spreadsheets. It's about behavior. It's about mastering yourself, your desires, your fears, and your ability to see the bigger picture. The smartest financial plan is worthless if you can't stick to it. The best investment is meaningless if you panic and sell at the wrong time. Success belongs not to the most intelligent, but to the most consistent. Consistency may not sound glamorous. It doesn't make headlines. It doesn't get you attention at dinner parties. But consistency is what builds fortunes, what creates freedom, what turns ordinary people like Ronald Read into millionaires. And consistency only comes when you align your money decisions with your psychology. When you stop trying to be perfectly rational and instead aim to be realistically reasonable. As we move forward, we'll continue uncovering how psychology shapes not only our personal finances, but also our collective view of money. Because the way we think about money doesn't just affect our bank accounts. It affects our happiness, our relationships, our choices, and ultimately, the stories we tell about our lives. We ended with the idea that the smartest financial plan is useless without consistency, and consistency comes from aligning money with psychology, not just logic. Let's take that further. Think about the role of control in our lives. At the heart of almost every decision we make with money is a simple desire, the desire for control over our time. Time is the ultimate currency. Money, in many ways, is just a tool we use to buy back time, to reclaim freedom from obligations we don't enjoy. Imagine waking up in the morning and realizing you don't have to do anything you don't want to do. You can work if you choose, you can rest if you choose, you can spend the day with your family or pursue a passion without worrying about bills. That feeling, freedom over your time, is what most people are chasing when they chase money. Yet in the process of chasing, many forget the goal. They build lifestyles that trap them instead of free them. They add expenses, obligations, and debt that take away their freedom. In the pursuit of wealth, they end up with less control, not more. So the real question is, how do you use money to maximize your control over time rather than lose it? The answer lies in living below your means, saving consistently, and resisting the temptation to match your spending with your income. Every dollar you don't spend today is a piece of your future time you've just bought back. It might not feel glamorous, but freedom is always glamorous in hindsight. And here's a deeper truth. Independence is one of the most valuable financial assets you can own. Independence means you don't need to bend to the will of a boss you hate. You don't need to compromise your values for a paycheck. You don't need to panic when markets fall because you have reserves. Independence is not about quitting work. It's about making work optional. Some of the happiest people are those who still choose to work, but work on their own terms, driven by passion rather than necessity. Now let's talk about luck and risk again, because these forces shape more of our lives than we care to admit. People love to tell success stories. They point to billionaires, entrepreneurs, athletes, and inventors and say, "Look, if you work hard and stay disciplined, you can achieve this too." But what these stories often ignore is the invisible hand of luck. Being in the right place at the right time, having access to resources others don't, being born into certain circumstances. All of these play a massive role in success. Take Bill Gates again. Yes, he was brilliant, ambitious, and hardworking, But he also had access to one of the few high school computers in the world in the 1970s. That single stroke of luck set him on a path others couldn't even dream of. Now consider his equally talented classmate, Kent Evans, who tragically died in a mountaineering accident at 17. He never got the chance to show his brilliance. Was he less capable? No. He simply faced different luck. Success stories are incomplete without acknowledging the invisible role of chance. But luck has a twin: risk. Just as luck can propel us forward, risk can drag us down. A bad accident, a sudden illness, an economic downturn, or simply being in the wrong place at the wrong time can alter a life forever. This doesn't mean we should live in fear, but it does mean we should approach success with humility. When we see someone doing better, we should resist the urge to assume they worked harder or are smarter. And when we see someone struggling, we should resist the urge to assume they are lazy. Outcomes are shaped by more than effort. They are shaped by forces we can't always see. This is why balance matters. Be proud of your achievements, but stay humble about their causes. Recognize your role, but also recognize luck's role. That humility will protect you from arrogance and prevent you from looking down on others. Another powerful lesson is that history is full of surprises. We think we can predict the future based on the past, but history is rarely a good guide. The world changes, technology evolves, and human behavior shifts. Consider the rise of the internet. In the 1990s, hardly anyone could have predicted how profoundly it would transform every aspect of life, from shopping to dating to banking. Today we take it for granted, but back then it was unimaginable. This means that when planning financially, we must expect the unexpected. Things that never happened before will happen. Markets will behave in ways no one predicted. Entire industries will rise and fall. Instead of being shocked, we must design our lives to be flexible enough to adapt. Flexibility is a superpower in finance. The more rigid your plans, the more fragile you become. The more open you are to change, the more resilient you become. Now let's return to compounding, because its lesson is so important it bears repeating in different ways. Compounding rewards patience, but patience requires faith. Faith that tomorrow will be better, that progress will continue, that your sacrifices today will pay off in the future. That faith is hard to hold when the world feels uncertain. But every great investor, every great builder of wealth, has one trait in common. They stuck with it long enough to let compounding work its magic. Think about someone who invests steadily in an index fund for 40 years. There will be crashes, recessions, and terrifying headlines. But over time, their wealth grows steadily, almost invisibly at first, then dramatically in the later years. The secret is not timing the market. The secret is time in the market. Yet people keep trying to outsmart the process. They chase hot stocks, time their entry and exit, panic when markets dip, and jump back in when they rise. Each time, they lose the compounding effect. Imagine cutting down an oak tree after 10 years because it doesn't look tall enough, never realizing that the real growth was about to begin. That's what impatience does. Another key lesson is that personal finance is personal. There is no one-size-fits-all answer. What works for one person may not work for another because our goals, fears, and values differ. For example, someone might prioritize building wealth to retire early, while another might prioritize spending money now to enjoy experiences. Neither is right or wrong. Both are valid, as long as they align with personal values. Problems arise when we adopt someone else's strategy without considering our own psychology. This is why copying others rarely works. We see an investor making millions and think, I should do what they're doing. But maybe they can stomach risks we can't. Maybe they can sleep at night while holding volatile assets, while we lie awake in fear. If a strategy doesn't match your temperament, you won't stick with it. And if you can't stick with it, it doesn't matter how smart it looks on paper. Here's a story to illustrate. Sarah and Tom are both investors. Sarah chooses a simple, boring plan. She invests steadily in low-cost index funds. Tom chases high-growth tech stocks, riding the waves of excitement. For a while, Tom outperforms Sarah, but when markets crash, Tom panics and sells. Sarah stays the course. Decades later, Sarah has far more wealth not because she was smarter but because she was consistent. The tortoise beats the hare again, not in a fable but in real life. And that brings us back to behavior. In money, intelligence matters less than temperament. The ability to stay calm, patient, and disciplined matters far more than the ability to solve equations or analyze charts. The biggest enemy in finance is rarely the market, it's our own emotions. Fear, greed, envy, impatience. These are the real destroyers of wealth, and mastering them is harder than mastering any technical skill. It's not about knowing what to do. Most people already know they should save more, spend less, and invest steadily. The challenge is doing it consistently, especially when emotions are raging. This is where self-awareness becomes a financial tool. Knowing your weaknesses, your triggers, your blind spots. Knowing that you tend to panic during downturns, or that you get tempted when friends brag about their gains. By recognizing these patterns, you can design systems to protect yourself. Automated savings, diversified investments, long-term commitments that prevent impulsive decisions. The best investors are not robots who feel nothing. They are humans who design their environment to protect themselves from their own worst instincts. And so, as we keep moving forward, the lessons keep circling back to the same truth. Money is not about what you know, it's about how you behave. Knowledge matters, but behavior rules. The question is not what's the best financial strategy, but what's the best financial strategy I can stick with. Because in the long run, the strategy you stay with always beats the strategy you abandon. We ended with the idea that behavior matters more than knowledge, and that consistency is the ultimate financial superpower. Let's continue exploring why human behavior shapes wealth in ways we often ignore. One of the most surprising things about money is how little it is tied to intelligence. You can be brilliant, educated, analytical, and still make catastrophic financial mistakes. Conversely, someone ordinary, careful, and patient can quietly build enormous wealth over decades. The difference is not IQ, it's temperament, habits, and the ability to think long-term. Think about investors during market crashes. History is full of stories where the smartest people lost the most. They calculated every risk, analyzed every trend, yet when panic hit, their judgment failed. Fear, greed, and impatience. These emotional forces overwhelm intellect. Meanwhile, people who simply stayed calm, continued investing, and avoided impulsive decisions often came out ahead. The market rewards behavior, not brilliance. This is why Housel repeatedly emphasizes the gap between being technically right and being practically successful. You might know the perfect investment, but if it keeps you up at night, if it tempts you to make rash moves, it is the wrong investment for you. The best financial plan in the world is worthless if it doesn't fit your personality. Success is not about being the smartest person in the room. It's about managing yourself better than most people manage themselves. Another lesson is the deceptive power of luck. People tend to overestimate their own skill and underestimate the role of chance. The truth is that outcomes in life and finance are heavily influenced by events outside our control. A brilliant investor might achieve success simply by being in the right place at the right time. A talented entrepreneur might fail because of market conditions, regulatory changes, or a single unforeseen event. Recognizing the role of luck keeps us humble and prevents overconfidence. But luck is paired with risk, and risk is unavoidable. Every decision carries uncertainty. Some people try to avoid it entirely by playing it safe in ways that don't actually protect them. Others take reckless risks because they underestimate the consequences. The key is not to avoid risk, but to understand it, respect it, and protect yourself from catastrophic outcomes. The world rewards people who survive, not those who are perfect. This is where the concept of a margin of safety becomes critical. The simplest example is the bridge analogy. Engineers build bridges to hold far more weight than they expect it to carry. Why? Because the unexpected always happens. In finance and life, you need a similar buffer, enough savings, enough diversification, enough room to withstand setbacks. Those who design their lives with a margin of safety are the ones who last and ultimately thrive. Housel also highlights the strange paradox of spending versus happiness. People think spending money will make them happy, but beyond a certain point, additional income contributes very little to emotional satisfaction. Experiences matter more than possessions. Time matters more than things. And yet, humans are wired to chase status, to compare, to keep moving the goalposts further away. This is the trap that turns financial freedom into a treadmill. Consider two hypothetical people. One earns a modest income, lives below their means, and saves diligently. The other earns 5 times as much but spends almost everything on status symbols, upgrades, and lifestyle inflation. Which one is richer? In terms of freedom and control, the first person is wealthier. In terms of social appearance, the second may look wealthier. This gap between appearance and reality is at the heart of Housel's message. Wealth is what you don't see, not what you flaunt. Let's talk about patience again because it is both simple and difficult. Compounding is powerful, but it only works if you give it time. Most people give up too early. They expect results immediately and panic when they don't see them. They chase trends, buy and sell impulsively, and then wonder why they haven't achieved their financial goals. The magic of money is rarely in flashy moves. It is in small, consistent actions repeated over decades. There's a story of a couple, Mark and Lisa, who invested modestly each month in low-cost index funds. For the first 10 years, they barely noticed their wealth growing. The returns seemed small, and the temptation to chase fads was strong. But they stayed the course. 20 years later, the investments had grown exponentially, giving them freedom they never imagined. Patience turned modest contributions into life-changing wealth. This is the lesson repeated across history. The world rewards those who endure, not those who sprint recklessly. Now let's consider the role of stories in shaping financial behavior. Humans are narrative-driven creatures. We don't think in equations. We think in stories. And the stories we tell ourselves about money influence how we behave. If your story is, "I will never be rich because I'm unlucky," you will make decisions to confirm that story, whether consciously or unconsciously. If your story is, "I can build wealth slowly and surely," you will act in ways that reinforce that belief. Stories are invisible forces, but they determine outcomes as much as spreadsheets do. This is why it's crucial to pay attention to your financial narrative. Notice the stories you tell yourself about money. Are they rooted in fear or hope, scarcity or abundance, victimhood or agency? Your narrative shapes your spending, your saving, your investing, and your long-term mindset. Change the story, and you change your financial behavior. Another critical lesson is the danger of overconfidence. People often assume their knowledge or skills make them immune to mistakes. The reality is, overconfidence is one of the most common causes of financial ruin. It leads to over-leveraging, excessive risk-taking, and ignoring signals that contradict our assumptions. Humility, in contrast, is a quietly powerful tool. It keeps you cautious, observant, and open to learning, traits that compound into financial success over a lifetime. We also learn that financial decisions are emotional, not purely rational. Every choice, spending, saving, investing, is filtered through our desires, fears, and biases. Knowing this allows us to design systems that compensate for our emotional weaknesses. Automating savings, diversifying investments, and creating rules that reduce impulsive decisions are ways to align behavior with long-term goals. These are not glamorous actions, but they are effective. And here, another paradox. Financial freedom often comes from humility, not ambition. Many people equate wealth with grandeur, believing that more equals better. But true wealth is quiet, subtle, and often invisible. It is having the freedom to make choices, to live according to your values, to sleep at night without anxiety. The loudest displays of wealth, mansions, cars, yachts, often mask fragility, because those lives are built on maintaining appearances rather than building freedom. This ties back to one of the most important lessons Housel emphasizes. Wealth is what you don't see. It's the money saved, the options preserved, the time you control. The world is enamored with visible signs of success, but the invisible foundations, the behaviors, the patience, the discipline, are what truly matter. Finally, we return to the central theme. Money is deeply personal. It is a reflection of our psychology, our experiences, and our choices. There is no universal rulebook that guarantees success. The best strategies are those tailored to your temperament, your values, and your goals. Understanding yourself, your fears, your ambitions, and your tendencies is more valuable than any formula, stock tip, or investment trick. As we continue, the next lessons will dive into the nuances of wealth, how to navigate unpredictability, how to manage greed and fear, and how to design a financial life that aligns with who you are, not who you think you should be. Money, after all, is not a destination. It is a tool, a story, and ultimately a reflection of our own behavior. We left off understanding that money is deeply personal, a reflection of our psychology, and that the invisible behaviors, patience, discipline, and humility, are more important than the flashy symbols of wealth. Let's take this further. One of the most powerful lessons in the psychology of money is that people rarely make decisions based purely on facts. They make decisions based on their personal experiences, their upbringing, and the stories they carry. This means two people can see the exact same data, yet make completely opposite choices, and both feel rational. Consider two families living through the same economic downturn. One family experienced financial security growing up, saw their parents handle crises calmly, and developed trust in long-term planning. They approached the downturn with patience, seeing it as temporary, maybe even as an opportunity. The other family grew up in scarcity, watched parents struggle, and internalized fear. They panic at the first sign of trouble, selling investments or cutting essential spending. Both are responding logically to their own experiences, yet the outcomes will likely be drastically different. Psychology, more than math, determines their financial behavior. This ties to one of the most counterintuitive lessons in money. Independence and freedom often matter more than income. People chase higher salaries, bigger promotions, and more assets, believing happiness comes from what they earn. But happiness often comes from what you control. A modest income with freedom is worth more than a high-income chain to stress and obligation. Money buys options. It buys the ability to say no. It buys the ability to leave a job you hate or pursue a project you love. And yet, people undervalue this freedom, chasing earnings instead of autonomy. Now let's explore the power of compounding from a behavioral angle. Most people underestimate compounding because it requires patience, and patience is the enemy of instant gratification. The true magic happens slowly, invisibly, often when you've nearly given up. Think of a gardener planting seeds. For years, the growth is imperceptible. Then one day, decades later, a massive tree emerges, shading the land and bearing fruit. Investing, saving, learning, and building habits all work like this. Slow, steady, almost invisible progress eventually becomes life-changing. Behavioral consistency is more important than intelligence. The smartest investor who panics during a downturn loses more than the patient investor who stays the course. Discipline compounds just as much as money does. Even tiny differences in daily habits, saving a small percentage consistently, avoiding impulsive spending, resisting unnecessary debt, accumulate into extraordinary results over decades. One story Housel shares that illustrates this beautifully is Ronald Reed, the janitor who quietly amassed millions. He didn't earn a massive salary. He didn't make spectacular investments. He simply lived below his means, invested patiently, and allowed time to work its compounding magic. The lesson is simple. You don't need genius to get wealthy. You need discipline, patience, and self-control. Another critical insight is understanding tail events. Life, markets, and careers are driven by a small number of rare, extreme events. Most returns or failures come from a handful of outcomes, not from steady averages. A single innovative company can produce massive wealth. A single accident can wipe out years of progress. A single opportunity can launch a career. Yet humans are terrible at predicting these tales. We plan for averages, assume smooth growth, and ignore the outsized impact of rare events. Preparing for uncertainty and unpredictability, therefore, is more important than chasing perfect strategies. This connects with the concept of flexibility. Rigid plans fail when life surprises us. Markets crash, businesses collapse, relationships falter, health deteriorates. Those who survive and thrive are the ones who build flexibility into their lives, extra savings, diversified investments, options for work, and mental resilience. The ability to pivot when events deviate from expectation is the ultimate insurance policy. Now let's discuss risk in a human context. Risk is personal. What feels safe for one person may feel catastrophic for another. Someone with no dependents, a secure job, and ample savings may take a high-risk investment without concern. Someone with a family, a mortgage, and limited savings might find the same investment terrifying. Risk is not abstract. It is experienced. Understanding your own tolerance, your own psychology, and your own circumstances is essential for making decisions you can actually stick with. And fear and greed are the twin forces that shape so many financial mistakes. Fear drives panic selling during downturns. Greed drives excessive risk-taking during booms. Both are amplified by human psychology. Even highly intelligent people fall prey to these emotions. The solution is not to eliminate them, they are inherent, but to structure your behavior so that your emotions cannot dictate disastrous decisions. Automate savings, diversify investments, build buffers. These are behavioral tools that protect against emotional mistakes. Housel also emphasizes humility. Many people overestimate their knowledge, assuming they can control outcomes. This overconfidence leads to excessive risk, leverage, and financial fragility. Humility doesn't mean lack of ambition. It means recognizing the limits of your control, preparing for surprises, and respecting uncertainty. Humility, combined with patience and discipline, is a formula for long-term success. Another key insight is the difference between getting wealthy and staying wealthy. Getting wealthy often requires boldness, risk-taking, and opportunities. Staying wealthy, however, requires conservatism, patience, and self-control. People who make large fortunes can lose them quickly if they abandon discipline in favor of greed or overconfidence. Survival is more important than spectacular gains. Wealth is fragile. Guarding it requires restraint. Let's revisit spending and happiness. People assume that buying more will make them happier, but research shows that beyond a certain point, extra income does little for emotional satisfaction. Experiences, meaningful work, and relationships provide far more joy than possessions. Spending should align with your values, not social pressures. And yet, most people inflate their lifestyles to keep up with others, trading freedom and security for fleeting status. This brings us back to the theme of control. Time, autonomy, and freedom are the ultimate forms of wealth. Money is valuable because it buys these things, not because it buys more toys. People who understand this principle design their financial lives differently. They save, avoid unnecessary debt, live below their means, and build wealth as a tool to gain control over life, not to impress others. The psychology of money is ultimately a story about human behavior. It's about understanding ourselves better than the world understands us. It's about recognizing our biases, our fears, and our tendencies. It's about designing systems, habits, and structures that align our behavior with long-term goals. Intelligence alone is insufficient. Knowledge alone is insufficient. The ability to act rationally, consistently, and patiently, despite emotions and uncertainty, is what separates those who build lasting wealth from those who don't. And perhaps the most important takeaway, your financial strategy should reflect who you are, not who you think you should be. Copying others is dangerous. Mimicking the wealthy, following trends, or chasing status rarely leads to happiness or financial security. Understanding yourself, your tolerance for risk, your goals, and your values allows you to make decisions you can actually stick with. Sustainability beats brilliance. As we move forward, the lessons will begin to focus even more on practical behaviors, how to navigate uncertainty, how to balance ambition with restraint, and how to design a financial life that supports happiness, freedom, and resilience. Money is not merely a tool, it's a reflection of our deepest psychology, our behaviors, and ultimately our choices.